Good morning. Welcome to White's Insights. Today is a market update that comes right after we've had the US CPI report from August, and there is a FOMC meeting coming up next week, in which the market is already expecting a 25 basis point cut. So within this larger context, we're going to review some of the macro elements of what's been happening before we look through the potential impacts for the September FOMC, rates, equities, Bitcoins, and gold. So let's begin. The August CPI came in at 2.9% as the headline figure. And if you strip away the volatile components of food and energy, the core CPI came in at 3.1% year on year. What we're seeing in terms of the larger picture is that inflation has come down significantly from 3 years ago during the hiking cycle. But over the past 12 months or to 18 months, it has been pretty sticky. At the same time, the Fed is getting a bit more concerned about the strength of the labor market. So what we saw in 2023 to beginning of 2024 was that the Fed was very much fighting against inflation, still trying to bring this final mile target of 2% home. At the same time, the labor market was very tight, very strong, very low unemployment rate. So the Fed managed to hold on to a very high Fed funds rate for 12 months. Before the easing cycle. Then September last year, we had seen a couple of bad non-farm payrolls data, and at the same time, if you remember, we had the carry trade unwind, a big shock in the equities market at the end of July to beginning of August. So those events rang the alarm bells at the Fed, so they started cutting rates again. And then coming to beginning of this year, again, the Fed is still more worried about the CPI, and we have seen pretty strong, consistently strong non-farm payrolls, 100K new jobs every month. So the Fed was shifting attention back to bring inflation back to 2%, and they have been holding the rates on. And one of the big factors was the uncertainties caused by tariffs. There was a lot of theories about how tariffs could bring sustained inflation, especially if you increase the tariff rate step by step every few months, or a one-off inflation, which is the price level increases to the tariff level, incorporating the changes for once, and then the inflation would be a transitory effect. Or tariffs could actually be deflationary because it could cause chaos in international trade, ineffective planning for the businesses, as well as destroying the demand side of the equation, therefore lowering the overall prices through almost recessionary impact. While inflation figures have been very sticky, the non-farm payrolls we'll see in a second did deteriorate recently with big downward revisions. So now the Fed is again alarmed by labor market weaknesses, and they're thinking of further cuts here. Just looking at the CPI report from last month, there's not too much to see. We're seeing energy prices year on year pretty stable, and we are seeing shelter prices coming down slightly, but very slowly. So 3.5% year-on-year changes in the rent, and 4% year-on-year changes in the owner's equivalent rent of residences. Now, looking at the unemployment rate and non-farm payrolls, so at the top we have the unemployment rate, as we see that in the past 3 months, we're seeing a uptick from 4.1% to 4.3%. And the 4.3% is the highest we've seen over the past 3 years, really going even further. So this new tick is quite alarming. The Fed has a year-end projection of 4.5%, so it is approaching towards the Fed's projection. And what's more alarming is the downward revisions of the non-farm payrolls of the past few months. So before Trump fired the head of Bureau of Labor Statistics, we have been basically seeing 100K plus jobs every single month, a very, very strong labor market. And all of a sudden, we saw a downward revision in May, in June, and July came in weaker as well. And then another downward revision that actually put June into a negative territory. So effectively in June, the labor market lost jobs as a whole rather than gained jobs. So in August, the non-farm payroll came in at only 22K, with a big margin of error as well. So it could easily be a net loss of jobs too. So this labor market picture is not very pleasant. It's not what the Fed wants to see. And unfortunately, does not afford the time that the Fed wants to wait and see. So this means that the September 25 basis point cut is a done deal, but I don't think they will quite want to do the 50 jumbo cut like they did before, because inflation is still in an uncertain place with the tariff impact, and it's still quite sticky around 3%. The thing about unemployment rate and CPI is, so the Fed has this dual mandate of maximum employment. By that, they mean something like 4% unemployment. It's not a fixed number. It's just the notion that if you wanted a job, you can get one in this economy. At the same time, we do have a concrete number for inflation, which is the PCE at 2%. But here we're using CPI because that's we've got the latest data. And the difference between CPI and PCE is a technical one. So CPI is only focusing on the urban areas, whereas PCE incorporates urban and suburban, so all the areas. So they have different component weightings. So the question is it actually possible to have maximum employment and 2% inflation at the same time? What we tend to see is that when we have very low unemployment and tight labor market, it could correspond with periods of higher inflation. So over here, so the Fed's goal is really to bring, if you look at this 2% mark, this area here I'm pointing at, 2% below 2% inflation and something like 4% unemployment rate is the dream. But it's all the economy had only really achieved this not many times before. What we tend to see is that we have lower inflation with rising unemployment rate. And that sort of makes sense. When you have people losing jobs, wages come down, the prices also come down because there's a demand side shock. And so you have workers earning less money, and not spending money at the same time. So you have higher unemployment rate and lower inflation. Whereas if you have a booming, strong labor market, you tend to see strong wage increases, which feed into core CPI, because the cost of services go up and cost of labor also come up. So it is more prone to the high inflation. But of course, in the past 5 years, the Fed has been adamant that you could achieve both goals, essentially, because you could have a tight labor market because the supply side is constrained. For example, removing tighter immigration controls, so you have fewer labor supply, but also you can bring down inflation by having high interest rates and reducing the Fed balance sheet, and effectively controlling the liquidity a little bit that go into the real economy. So if we look at the past 30-year data, well, what we see is that with unemployment rate coming down. We do have periods where inflation always also comes down. So this is a really nice period. But then we get periods where unemployment rate spikes and inflation rate crushes. And that's when the Fed starts to ease because they focus on the labor market and trying to get inflation back to 2%, etc. Again, 2008, we'll have unemployment rate spiking and then the inflation rate tanking over here. Again, in 2020, huge unemployment rate and then nearly deflation territory at the beginning of the year. And then that picture flipped. Unemployment rate came down to really tight, historically tight labor market. At the same time, CPI went down massively to nearly 10%. So to get that happy balance for the Fed is actually pretty difficult and pretty rare. So the Fed's track record of getting it right is not very good, which is why you see these big swings in both the unemployment rate and CPI over time. Now, looking at the market projections of the FOMC decisions in the next 12 months, we're expecting a cut in September, so 25 basis point there, potentially another 25 basis points in November and December before 10 basis points projections for the remainder of the 12-month period. So the market is really expecting pretty aggressive cuts going into the year end because of the labor market weakness. So my question here is really with equity markets at the all-time high and unemployment rate at 4.3%, but not quite above the Fed's red tape of 4.5% in their own projections. Are they really going to panic and do the 3 cuts that the market wants? Or are they going to be a bit more constrained and try to do 1 cut, see what happens, get more data, see if the labor market is really coming down fast, and then do another cut maybe in December, which would be in line with their previous projections. The good thing is that we will get a fresh set of Fed dots in this time round in September FOMC, as well as the renewed expectation for the labor market and inflation rates, etc., next week. So we get a bit more clarity on what the Fed does. Now, looking at the US Treasury yield, so this is just the outright yields between the 1-year and the 30-year. This 30-year has come down a lot. Things have been moving pretty quickly. At one point, when I was looking at the chart, it did really feel like it was going to rally from the 5% level into 5.3, etc. But we didn't get that. And instead, we got a U-turn after the non-farm payrolls data. And now we're seeing significant pricing for the Fed cuts in the front end, which dragged down the whole yield curve. So this is a cycles analysis I have developed over the past month. This is a completely proprietary analysis. You may have seen similar ideas, of course, concepts elsewhere, but we use our own data and we use statistical methods to find the top 3 cycles within the market movements of the past 3 years and put them together and map them onto the actual price data. So what the idea is that the market movement isn't completely random like the efficient market hypothesis. It has its own rhythms. Investors operate in their own rhythms. We have the Fed easing in cycles, and if you can think about the cycles as beats in the music, the market has its own rhythms over time, and there are periods of market tilting upwards, and there are periods where the market is positioned downwards through this cyclical beat. And there's also the idea that there isn't just one cycle. Sure, there could be a dominant cycle, dominant theme over hundreds of days, but there are multiple long and short-term cycles that we could detect and put them together for analysis. So what you see is that the dotted line here is the dominant cycle for TLT, the bond ETF. And it operates in a 150-day cycle. Every 150 days, we get an up and down rhythm, which has concurred with the price data largely. And we also put together the top 3 cycles we detect over time. And you can see that sometimes the top 3 cycles reinforce each other into a much larger wave, or sometimes they offset each other into a smaller wave here. So that's how this chart roughly works. The good thing about using the cycles analysis is we can actually project those cycles forward based on the past cycles and have an intuitive understanding of where the market is headed overall. And you can think of them as the wind in the background. And those cycles are not stationary, and we're trying and we're applying statistical methods to put them into a chart. So over time and with different look-back periods, we could detect different types of cycles. So there is some room for judgment. We combine this with other methods we use, such as machine learning, technical analysis, liquidity analysis, to have a great picture of how the market operates. So looking at the equities market after CPI, we had a very strong session. So the blue lines are the last 20 sessions of SPY, and the orange line is yesterday's session. Yesterday, we finished among the top 4 of the last 20 sessions, and we essentially opened high and stayed high. The bears are nowhere to be found, so that's very encouraging. Year to date, we're up nearly 13%, which is above the top half of the past 10-year performances at this point of the year. And if you think about the volatility we endured, the drawdown we suffered from at the beginning of the year, where we are now is pretty remarkable. And this chart generally helps you to understand that first, this great dispersion year to year. So even though on average, SPY or S&P 500 increases by 10%, and it has been high in the past 10 years, but let's say 10% over a long period of time, over decades, the annual performances can vary a lot. You get years where it could finish down 20%, a COVID year like this one, but it finishes up pretty positively by the year end. So this really helps us understand that the markets, to understand the market dynamics in the past decade. And if we sum up the performances, this 2025 is actually a very much above average year compared to the 10-year seasonality. So now we're looking at the cycles analysis for SPY. The dominant cycle is actually much shorter than TLT, is 75 days, but it shares closely with the second best cycle, which is a 188-day long cycle. And if you put them together, we can see the cycle peak was in March from last time, and we started a decline in March and April. And since then, actually, the market has recovered better than what the cycle suggested, but it's largely following the dominant cycle, the dotted line here. And we've seen a slowdown, but it's still a very big market price action in the past couple of months. And now we're again back to this incline and approaching the peak of the combined cycle as well as the dominant cycle itself. So if you follow this chart loosely, you can see that this year, the September weak seasonality is somewhat dispelled by the cycles we detect over the 3-year period. And now looking at the technical chart, we had a lot of false starts for this potential wave for pullback, but we actually never quite got it. This trend line from May is still standing pretty well. We only breached it once, and we managed to climb back above it straight away the next day. So My read is that we're still in this very strong wave three since the April low, and that is now approaching 20% extension of wave one. And this lasts forever? Of course not. But in the near term, it could easily stretch to 292, which is a 2.38 extension. What I would suggest is that, so when we reached the 638 level, already said that above 1.76 extension, we're in a stretch territory, but don't fade the rally and try to short the market until we get a sustained breakdown of this trend line and ideally below the 15-day moving average, which we never got. So as long as the market is in the uptrend, we should just ride with it and try not to short it. Whether we can get to 690, which would be crazy valuation levels, there's no reason why it cannot. In terms of market swings, just like there is no reason why it couldn't get to 480 back in April, right? So no one back here, when in January, February, thought we could see SPY at 480, but we got there. And likewise, when it's moving back up, there is no reason why we can't get to 690. In the short term, a lot of the market fundamentals, valuation are not really that important until they become important. So if you think about liquidity, valuation, technicals, cycles, for example, they are all, you can think of it as elastic bands, and investors care about certain things at a certain time, and they can get really stretched, and then it could snap back after at some point. But you have to accept that the elastic band can stretch towards one of the factors for a long time. So you could be right, but too early. And that is often the case for bears. QQQ, we are looking very similar in terms of a cycle. And we have this more near-term trend line here as support. It's made a new all-time high. It's traveling above this 200% extension of this wave one. So it is also in extended territory. And what we had seen happening is that QQQ recovered faster than SPY, overtook in terms of the progress, and it stalled a little bit, waiting for SPY to catch up. And now we're trying to approach the 238% extension of this wave one at 609. And we could really, and with the market sentiment here, we could challenge that. And we could stall after and pull back for wave four after the a week after September FOMC, when people are thinking, oh, maybe the Fed cut rates because the economy is really that bad. So we have all those narratives ready, but until we see this trend line being broken, the 50-day moving average being sustainably broken down, we shouldn't try to fade it. So looking at TLT, so TLT frustrated our model quite a bit back here. And I think the bullish and the bearish calls were very, very close. So we saw the signal switching a little bit during this period. But since late August, the model has been very decidedly bullish for TLT. And we have seen TLT breaking above this medium-term resistance all the way from last year. And now it looks like my previously bearish expectations, based on the worries about the debt issuances and budget deficit, could be invalidated. And I want to see TLT breaking above this high here. But at the moment, I'm definitely leaning much more bullish than before. And what we could have, I think we're still a bit early in confirming this structure, is that we have an ABC here for a large degree wave A, and an ABC coming down for larger degree wave B, and potentially another wave C up towards the 100 mark for this larger degree wave 4 completing. US oil has been quite boring in the past month. We're hovering around the 200-day moving average. between the 200-day and the 50-day in blue. Because we couldn't quite get over this high here, overall, it does look like we are starting a more bearish trend. What we have seen is essentially a ping pong match. What we have seen from US oil is a mean reversion trade in this very wide range, but very often above 70 and below 80. So I'm pretty neutral here. I do expect a more bearish move in the near term, but it's not with high confidence right now. Bitcoin, we've had a couple of constructive weeks in terms of price action, and now Bitcoin is right around the 50-day moving average. We want to see it break above it, and that could actually confirm my more bullish potential of this nested 1-2-1-2 in red, which would result in a much higher cycle end target. Because if we don't get past this, then we've had the 5 waves up. This looks not really that strong as a 5-wave cycle. So I'll be pretty disappointed if we actually this structure just completed over here. We have seen our machine learning model still on 0 for the past week. I think the price action hasn't quite moved the model into a more bullish expectation. But I do suspect if we get a couple more days or a strong weekend plus Monday, we could see model being risk on again. So there is a high correlation, positive correlation between Bitcoin and the stock market, and Bitcoin's recent price action has been a bit more constructive. Ethereum, our model has been consistently risk on. I am expecting a wave 3 high at over 5,600 in the near term. I think we have consolidated in the past month, which is pretty natural given this very steep run up. But I don't think we are done yet. I don't think this is a cycle top. And I remain pretty bullish on Ether in the near term. Solana is a bit earlier in its trajectory than Bitcoin and Ether. So it looked like Bitcoin rallied first, then money rotated out of Bitcoin into Ether, and now the alts, Solana is also benefiting from it. So I do think Solana has pretty good potential to hit 300 or more in this wave 3 of 3, but ultimately potentially even 400 for this larger degree wave 3. Coinbase, our model has been risk off for Coinbase in the past couple of weeks now. And Coinbase has managed to stay right above this 50% retrace of this wave 3, but is still under the 50-day moving average. So technically speaking, we're in a very neutral region here, where there is a lot of build-up in terms of volume. For me, just based on the charts, I do think that if we get to this 260 level here at 0.618 retrace of this wave 3, it could be a pretty good dip buying opportunity. There is the 200-day moving average here, of course, but also quite strong volume profile here as support. So if we are holding here for the low of the wave 4, challenging wave 5, the risk reward is pretty compelling if you have a stop potentially at wave 1 side here. The thing to note about Coinbase is that it's an extraordinarily volatile asset, more volatile than Bitcoin and potentially Ether too. If you look at the overall price pattern, it tends to drop 50%, rises 150%, and then drops another 50%. It does very large swings over the monthly, over the years. So that would advocate for smaller position sizing in terms of keeping the overall portfolio volatility neutral. Robinhood, I do think the inclusion of Robinhood potentially has started this wave 5 already, and that could put us to a easy target of 130 as a first stop. That is the 138% inverse extension of this wave 4, and we're well above the 200-day moving average and the 50-day moving average again. So we are back to a pretty pleasant uptrend. Looking at gold, gold reached our minimum target of 335 for this wave 3 in a pretty direct fashion as well. So over just under 3 weeks, we got to from the middle of this range to the wave 3 target. So we did see a big intraday dip here, which could be potentially a wave 4 low, but I would prefer a proper retrace more towards the 320 handle, which would be a very nice retest and a viable dip for the final wave 5 at 350. Looking at Apple, so Apple just launched its iPhone 17 products. Apple has recently seen a bit more acceleration in terms of customers trying to front run the tariffs and buy iPhones ahead of the price increases, etc. And of course, now it's riding on the bullish wave since the announcement with the White House about its additional investments in the US. For me, this breakout above the 200-day moving average with a potential golden cross forming only increases my conviction that we are going to reach 265 for this minimum wave 3 target, which is the 1.38 extension of this wave 1. So I'm pretty bullish on Apple. And if you follow my 4-3-2-1 system, you can see that Apple has been scoring pretty highly in the recent days. Amazon, I'm pretty bullish for Amazon as well. I do think we're now likely in this wave 5. It's in a pretty controlled uptrend, rising a bunch, and then we get some volatility testing the 50-day moving average. But overall, I do think 250 is a pretty achievable target for this wave 5 here. And Amazon's valuation is also middle of the ballpark, is also the middle of the ballpark with its Max 7 peers. Less expensive than Apple and Microsoft and Tesla, but slightly more pricey than Meta, Google, and NVDA on a growth adjusted basis. Google, pretty bullish price action. What we are seeing is a very stretched wave 3 run, 200% extension of this sub wave 1 within the larger degree wave 3. I do think that the run is pretty stretched here, so I'm cautious. But again, remember what I said at the beginning regarding S&P 500, find out the shorter market or fade the rally until we see the near-term trend reverting back down. So Meta, we tested the shallow end of the wave 4 below the 50-day moving average. And it's not actually terribly clear whether this is the B wave yet and we have lower to go. I would lean towards this potential, and I would prefer to see it because we had very shallow waves 1, 2, and 1, 2 here. So if we get a nice wave 4 correction, deeper pullback towards 680 to 700, that would be a nice setup for this wave 5 to finish. Microsoft also met our initial target of this wave 4 at 500. There is room below at 470. There's a big volume here. It is still below the 50-day moving average, so overall is not that bullish yet. The model has switched onto the bullish mode today, but in terms of the price action, I do want to see Microsoft at least getting back to above the 50-day moving average, and at least getting towards above this high before we can conclude wave 4 has ended. NVIDIA's pullback is very shallow, and already we're back to the levels around the all-time high here. I am slightly concerned that this volume profile here is distribution post-August, and this could be a wave B, and we can challenge a deeper wave 4 target at 144 to 160-ish. But we need a bit more time to confirm our reading. Tesla, we enjoyed a strong breakout on Thursday, up 6%, breaking decisively above this short-term resistance here. It previously attempted 3 times, and on the 4th go, we broke out on the 5th day. So we're now at the high of May, where just before Elon broke up with Trump on social media, and also we are above this wave B high, or just right at this wave B high. So overall, we're seeing a very constructive pattern of Tesla having bottomed over here, and we are moving nicely alongside this five-wave motion for first wave A target. And I'm optimistic that we could claim back the all-time high this year at the end of this 5th wave. So my wave 3 target is at 416 to 443. It could even stretch higher to 460, well within the normal wave 3 zone, at 1.38 to 1.76, extension of this wave 1. And we might see a lot of people FOMOing and trying to chase this rally here. Palantir, our machine learning model has switched to a bullish mode. So there's a chance that we have completed this wave 4 here. Now we're also above the 50-day moving average. If that is the case, we are potentially seeing wave 5 being at the 210 level to even 240 level, this range here. SOXX, it has been more bullish than I expected. We're already seeing a new local high, so potentially we haven't really started wave 4 pullback yet, and we could expect a deeper wave 4 pullback down the line. So this is just a fake out. There's no rush to short the market here. So I think we need a bit more time to just observe how far we can take this rally, and then thinking about wave 4 pullback. I don't deem this to be a proper wave 4 pullback, so I don't think wave 4 has actually come yet.